I want to talk to you a little bit about the importance of reading your statements properly and your financial plan. We're all trained to look at the annual percentage return. That's what we do, right? You pull up your 401k and you're like, well, what's my annual percentage return? Interestingly, that's actually the third most important number. The first most important number is the number that you are compounding. In other words, your balance, your principal. Now, what I'm really illustrating here is how to get a better return. Okay, to get a better return, first you focus on the number you are compounding, but I'll spend more time on that. The second thing is the frequency of compounding. Okay. Now, what that means is the interval, or how often you compound. Is it monthly? How many months? Is it daily? How many days? And then third is the annual percentage return. Okay, so moving on, for the sake of time, this could very easily be a 4-hour lesson, but I'm not going to make it a 4-hour lesson. We're going to do 1 hour. I promise. I'm going to do my best. All right. So here's some examples just to kind of help hammer this home. Let me see if I can get this moved over so that I can be in the picture. All right. So what you have here is examples. The first one over here is case A. All right. This is very easy. So over a 3-year period, you earn 5%, 5%, 5%. Well, then you have an average return of 5%, and you also have a compounded return, or what you actually made of 5%. Right? Simple. Now look at case E. For the sake of time, we'll just skip to case E. And in the first year, you have a great year. You earn 30%. You're feeling pretty good about it. The second year, we're going to go down 25%. It is very important to recognize that you're now negative. You went up 30 and down 25, but it's 25% of a greater number, right? The third year, you're up 10%, and you still have an average performance of 5%. And it might even be presented to you like that, sadly. But you only earned 2.3% per year. Or case F, up 40%, down 35%, up 10%, still have an average return of 5%, but you didn't really make anything over that 3-year period. Interesting, don't you think? I know you can't answer me, so it's automatically rhetorical, right? Sorry, I've got a pretty weird sense of humor. All right. So that was the end of that slide section. So I want to go through, with the last bit of time that we have here, I want to go through and just kind of talk to you about some stuff that you may already know, but I'm going to point it out in a different way than you've seen it before, and kind of an approach that I would say is better. Now, this is an approach that we use here at Main Street Advisors, but it's also an approach that you can do on your own. And so I really want you guys to pay attention here. So the Wall Street method of investing could be referred to as modern portfolio theory. Modern portfolio theory could be oversimplified and be referred to as a word I know you guys have heard a million times: diversification, right? All heard that. I keep asking you guys if you're hearing me, and I can't hear anything. I know you're there though. So diversification, right? Why do we diversify? Well, I would say that primarily it's to control volatility, right? Or to prevent losses to some degree, but secondarily, I would say it's to gain access to investments that you might not otherwise be exposed to, right? But this might seem a little complicated, but I assure you it's not, and it will make sense. When you really get deep into the weeds, and we're not going to get deep into the weeds, you learn about the Greeks: alpha, beta, theta, rho, vega. These are all things on how price is affected by different things. But there is one that I like to talk to everybody about. I think it's important that everyone has an idea of what beta means. Now, the way that Wall Street uses beta, I don't totally agree with it. Typically, when you see an investment that says beta, it's giving you an idea of how it moves in respect to the S&P 500. When in actuality, if you boil it down, beta is the same thing as the word correlation. Meaning, how does something move in respect to something else? Well, you can take any two assets and you can actually come up with what's called a correlation coefficient, okay? Sounds complicated, but it's really not. It doesn't matter what it is, a stock and another stock, a stock and a bond, a piece of real estate and a business, okay? If it is possible to come up with a correlation coefficient between these two assets. A -1 means that it moves in the opposite direction. A +1 means it moves in the same exact direction, okay? A 0 means it's got nothing to do with it. It's kind of the holy grail of diversification. Now, I will say that you guys are all familiar with the meat and potatoes, right? The meat and potatoes of investing are stocks and bonds. And in case you're not terribly familiar, stocks are when you own something, and bonds are when you are loaning something. So you can think about it like that, own and loan. But traditionally, we are taught, and we've been taught this for a long, long time, that the correlation between stocks and bonds is on the negative side, somewhere over here, right? Maybe like -0.85. And what that means is that the price of stocks and the price of bonds are supposed to be moving in opposite directions. And that's why it makes sense to diversify, right? The problem is, and most people aren't aware of this, is how bonds work. Bonds work like a seesaw. Oh, I'm drawing off the side here. Let me scoot that over. Like a seesaw or a teeter-totter. On one end, you have the price of the bond, and the other end, you have the interest rate or the yield, right? And almost 40 years, okay, almost 40 years, the longest really anything's gone in one direction before, interest rates were going down, right? There was a few blips here and there, and that meant that the price of bonds were going up. Drawn off the side again. Well, what happened in 2022? Well, in 2022, of course, the Federal Reserve comes out and starts raising interest rates. And what happens is that all the bonds that currently exist start losing their principal value. Think about it like this. Let's say you go buy a 10-year treasury a year and a half ago for 3.2%, all right? And now you're looking at the 10-year treasury at, say, 4.2%. And you're like, you know what? I really would like to sell that 3.2% bond and buy the 4.2% bond, but somebody has to be willing to buy it from you. Every trade has a buyer and a seller. And every trade has a winner and a loser. Money doesn't disappear. It changes hands. And this buyer of your 3.2% bond is going to go, well, why would I buy your 3.2% bond if I can buy a 4.2% bond? Right? This is an illustration to you, a microcosm of how bonds as an asset class lose their principal value.
Click the card in the corner of the window to continue this webinar. Please remember to like this video and subscribe for more educational content.